Yeah, so equity markets for November were mixed. Certainly Australia was weaker than most of the rest of the world. So Aussie markets were down in the order of 2 to 3%. Financials lagged, and I think that's on the expectation of what's going on with the central bank. Interest rates, we talk about interest rates a lot. That's a key part of the outlook for certainly financials and what margins they're taking in terms of what they're lending out at and what they're borrowing it against, or mortgages and deposit holders, that tension. And there's a bit of a rotation into some of the more defensive sectors domestically. So while the market generally lagged, the better performing sectors were healthcare and staples, which I suppose gives an indication that people are looking at some of the defensive elements of the market and looking for a bit more conviction in the positions that they're putting into their portfolios, rather than being willing to buy growth at any price. Yeah, so global markets were more positive than the domestic. It was quite volatile through the month though. So I think there's a bit of a question mark over valuations for some of the expensive or some of the larger cap technology stocks and what the outlook is for those businesses. Now, you had one big business with NVIDIA produce a quarterly update in the month, and it was a reasonably robust number. And now heading into where we are at the moment, you're starting to see some positive announcements from competitors to NVIDIA as well. So the outlook there's still positive. Now the question is though, there's a lot of spend going on and question marks over how valuable or how risky that spend is. So the capital expenditure cycle of some of the second and third players, in terms tiering, you think of the Microsofts and Nvidias and Alphabets that are the market leaders in their space. You've then got the data centers and some of the software providers that are beyond the top tier providers, that they're spending a lot of money in AI as well. And then you've got some startups going down to the low end of the scale as well in terms of the scale of businesses. There's question marks over, well, is the AI spend sustainable? Is the AI spend at some stage not going to generate revenue that's expected? And you're talking enormous numbers in terms of the expectations of what the revenue outlook is for the sector as a whole. And so you need all of those things to work as you would hope, or as you predict or forecast. And there's a lot of errors that can come into forecasting. But that's, I suppose, some of the questions that the market's now raising is, are the valuations that are for some of these businesses, are they sustainable? And is there some risks in that part of the market which led to some volatility in the tech sector, certainly globally? Coming out of COVID, you had a lot of continuity in policy. So rates were cut because no one had any idea of what the impact of COVID would be and what they needed to do to ensure that businesses and companies and economies survived. And coming out, obviously inflation spiked, and that was seemingly out of control. So the central bankers really went hard with increases in rates, and clearly that impacted markets in a challenging way through 22. 23 started to normalise. Now you're getting to a point where economies are standing on their own 2 feet, and so you're starting to have normalisation in policy, where there's differentiation between policy as well. So you've got Japan and potentially Australia that are doing rate moves that are different to other economies, on the back of what is still a tension between inflation and full employment that the central bankers are targeting. That plays through into many other parts of the markets. So currency, you've seen some support in currency for the Australian dollar. So that's now broken out of that sort of 64, 65, touching 66 cents. It's now pushed out of that and seems to be a bit more sustainable at that higher level. You've got bond rates, which have changed significantly. So they've broken out of what's been a pretty stable range for a long period of time, certainly through this year. And big differences between what it is here, which is, I think, the 10-year numbers are about 4.6, 4.7 at the moment, and US dropped below 4 for a period of time, and it's probably a little bit above that now. So it's quite a big difference. And that interest rates are really important because they flow through to all sorts of other asset classes in terms of whether it's valuation, whether it's opportunity cost. That makes a big difference. You have to look at what the different opportunities are, which you're always doing, but as it's not in unison now, so it's not all things happening at the same time. So you've got to contemplate and think about policies and think about positions in a bit of a different way. So you're still looking at the long term, you're still looking at the opportunities that are around today for the long term, and that hasn't changed significantly. So there's normalisation in rates. You're getting reasonable rates of return from bond markets, so that's a positive. Stability there gives you confidence, and I suppose stability and reductions give you confidence in real assets. So property and infrastructure do better when there's stable or lower rates, stable inflation. And then equities, obviously, those long-dated cash flows that get discounted by fixed interest rates and bond yields. The more stable or the lower they are, the more valuable they are today than what they are longer term. 2026, we're watching economic data very closely. So the expectation, clearly with interest rate cuts in the US, is that there's probably a slowing economy in the US. Clearly the economy there's had to digest a lot of political or policy uncertainty. We've had the tariff announcements, we've had sort of a backing down of some of those initial proposed tariffs. We're landing on something that's in the order of sort of 15 to 20% tariffs as a norm or standard across the board on average. So that will be something that will impact. It'll impact consumers, it'll impact businesses. It's still a little uncertain as to how that gets pushed through to the end consumer. So there's probably a bit of that being absorbed by companies and by the consumer as well. So inflation's probably one that you need to watch a little bit there, and then how much pressure there's still on the consumer and how much I suppose free cash they've got to be able to spend to continue to support economic growth, certainly in the US, and then as you think more broadly around the world. In terms of other asset classes, so we're still quite positive on some of the faster growing economies. So emerging markets from a valuation perspective still look appealing. We've been saying that for a while, and it has recovered or sort of, I suppose, bettered some of the larger cap or developed markets through 2025. The valuations are still appealing. So that's something that we would still see that as being a core part of many portfolios. And the real assets as well. So there's still valuation opportunities and appeal in some of the real estate and infrastructure securities that with lower rates and a bit more confidence that rates are probably going to stabilise hopefully through 2026, that you'll start to see some further support for some of those assets and a bit more normal environment probably for the supply and demand characteristics certainly for real estate, which has still been challenged since we've come through COVID with a bit of uncertainty on the return to work front. Core message comes back to diversification. Make sure you do have a well-diversified portfolio. We're reassessing our portfolios in some respects at the moment in terms of trying to make sure that we do have a breadth that we're comfortable with in portfolios. So that's something we'll continue to consider as we move ahead. And that's just looking at exposures that are beyond the mega caps, which we do have a reasonable exposure to across most portfolios. But just making sure that we are still convicted in the managers that we've got and that they are doing what we expect them to do, which is looking for that diversified outcome across portfolios over the longer term.